Good afternoon. Today we are presenting Microsoft's proposed acquisition of Docusign.
For our 2019 Q1 investment strategy, we plan to utilize our capital to continue making acquisitions that align with our business strategy. Within our proposed acquisition, we will be targeting the sales and marketing section, particularly in our computer systems and cloud offerings. We intend to leverage our acquisition of Docusign to enhance our existing products and services, specifically Microsoft Office.
To give a little background on Docusign, the company helps organizations connect and automate agreements. As a cloud-based solution, Docusign offers e-signatures on nearly any device and provides services to hundreds of millions of users in over 180 countries. These services can be utilized by a variety of industries, including real estate, financial services, healthcare, technology, and many more. Since its initial public offering in April of last year, Docusign has experienced incredible growth and currently has a market cap of over $9 billion.
We recommend Microsoft purchase Docusign stock through a negotiation process with Docusign management. In light of our current business relationship with Docusign, we foresee a smooth negotiation process that avoids the negative sentiments of a hostile takeover. We see this as an extension of our existing partnership with Docusign and want them to feel the same. By acquiring shares through negotiations with management, we will avoid the appearance and negative sentiments of a hostile takeover.
We considered an alternative option to acquire Docusign's assets, but ultimately decided against this acquisition strategy for several reasons. First, Docusign currently holds a lot of cash on hand and does not need immediate cash that asset purchases typically generate. Additionally, an asset purchase is typically used as a method to acquire a single division or business unit, but our acquisition strategy is not targeted toward one specific business division of Docusign. Furthermore, identifying, valuing, and transferring assets would be time-intensive and unnecessary since most of Docusign's assets are digital.
We do not seek a controlling interest in Docusign, but a 30% stake. Docusign is doing well with a large market cap. Considering this, acquiring a controlling interest would be incredibly expensive and provide little additional benefits. Our pre-existing business relationship signals that Docusign will be open to further integration, meaning a controlling interest is unnecessary to ensure Docusign's cooperation in incorporating their software into Microsoft products. However, if we are going to commit to offering Docusign and Microsoft Office bundles, we want a stake in their company, not just a business relationship.
We are prepared to offer $4.01 billion for the acquisition of Docusign. This will be accomplished by offering 20% of the consideration as cash, or $802 million, and 80% as stock, equivalent to 26.5 million shares at a price of $120.95 per share. In return, we will acquire 72.6 million shares at a price of $55.25 per share, giving us a 30% stake in Docusign after the issuance of new shares.
As a corporation, our financial health is stronger than ever. We have seen a steady rise in our service revenue, a trend we think Docusign will only perpetuate. Services revenue for the 6 months ended 12/31/18 increased by nearly $7 billion, while product revenue increased by only about $1 million. Taking a more in-depth view at the quarter ended 12/31/18, product revenue for the quarter was down by $1.5 billion, while service revenue was up by over $5 billion. The data shows where the market is moving, and we want to make sure we are staying ahead of these trends.
Looking at these various measurements, it is clear to see that Microsoft is stronger than our competitors in all categories, further promulgating our assurance that the acquisition is financially feasible. We have also recently sold off some old investments, freeing up cash which we can better allocate into growing service industry, leading to higher returns for Microsoft.
The post-acquisition impact on our financial statements will be minimal. Without a controlling interest in Docusign, we avoid creating new accounts or creating the need for consolidated financial statements. The only changes will be our cash account will decrease by $800 million, and our shares outstanding will increase by 26.5 million. We have identified a long list of expected synergies for this acquisition that prove hopeful for the future potential of this deal.
From a financial standpoint, we identified that both Docusign and Microsoft are driven by subscription-based revenues. This means that our primary sales strategy to increase our product users will complement one another and ensure continued growth for both companies.
Expected synergies with our acquisition of Docusign stretch beyond just revenue and growth. From a relational standpoint, Docusign and Microsoft have a pre-existing partnership from their products. Microsoft currently offers Docusign as a productivity technology and can be purchased and installed via the Microsoft Store.
Technology integration is a promising expected synergy because we have already determined that Microsoft and Docusign's technologies are compatible. We propose that Microsoft could incorporate a Microsoft Office Plus offering in their subscription services that would include Docusign technology in the bundle at a discounted rate. This offering would ensure mutual benefit for Microsoft, Docusign, and product users by offering cost savings and convenience to our customers at Microsoft, while also increasing user rate for Docusign. Finally, competitors such as Adobe are working to create similar e-signature platforms, and this acquisition will ensure that Microsoft stays ahead of the curve.
Beyond the bottom line, both Microsoft and Docusign strive to uphold corporate social responsibility goals. Microsoft aspires to enable a sustainable future, with the primary focus in waste minimization. The Docusign for Forests initiative aligns with our CSR goals by inviting customers to be environmentally friendly by moving their paper-based processes into Docusign. Furthermore, Docusign commits to donate a portion of their revenue to protect forests around the world, a responsible commitment that Microsoft can market to our customers, making them feel good about their choice to use Microsoft and Docusign's products.
We feel this new business relationship will be beneficial not only to Microsoft, but also to Docusign for the following reasons. An extension of our established partnership would allow Docusign to have access to a broader range of customers through our global customer network, which includes nearly 1 million companies and countless individual users who currently utilize our products. We also feel that the 30% stake will be attractive to Docusign. Docusign is financially healthy and is consistently growing, so they will likely not want to become a full subsidiary of Microsoft. Our 30% non-controlling interest would manage this concern. This percentage is also recommended because of our pre-existing relationship and want to avoid the feelings of a hostile takeover. As a sign of the expected mutual benefits for both Microsoft and Docusign, we plan to offer Docusign a portion of our stock in return.
Our proposed acquisition of Docusign will have many benefits for both parties, but the acquisition also presents some interesting accounting issues. Because we intend to acquire a 30% stake, we will use the equity method to account for our investment.
As we are acquiring our share in Docusign through stock and not asset acquisition, there will be no accounting issues in relation to asset valuation. We have relied on Docusign's market cap and the value of our proposed respective shares to value the company.
Secondly, we are not acquiring a controlling interest, and thus Docusign will maintain separate incorporation and continue to produce separate financial statements. We intend to perform a one-time acquisition in order to obtain the 30% stake we currently seek. If in the future and based on Docusign's continued success, we choose to obtain a greater stake, we can then increase our shareholdings in the company at a later date.
Our proposed strategy involves incorporating Docusign's platform into existing Microsoft Office 365 packages. Because we are not purchasing Docusign software, there will be minimal intra-entity transactions. With our proposed bundle idea, whereby we offer Docusign as an extension of existing Office 365 products for an increased price, a portion of this revenue will be attributable to Docusign. We intend to have a 50-50 profit split of the excess revenues generated from the Docusign service add-on. For example, if an individual were to purchase a Microsoft Office package originally valued at $20 and add on the Docusign service for an additional $10, we would share evenly in the $10 excess profit with Docusign. The journal entries would be as follows: debit cash or accounts receivable for $30. Credit sales for $25, and credit revenue payable to Docusign for $5. At the end of each quarter, we would debit revenue payable to Docusign and credit cash for the full value of the account payable to prevent this account from showing on our balance sheet.
One of the main challenges in accounting for the investment will be Microsoft and Docusign's different fiscal year ends. ASC 323 provides guidance on accounting for investments under the equity method, but there is no specific information regarding accounting for investments with different fiscal year ends. However, ASC 810, which outlines accounting procedures for consolidations, states that it is generally permissible to use a subsidiary's financial statements for consolidation if the difference in reporting periods does not exceed 3 months. DocuSign's fiscal year end is June 30th, while Microsoft's fiscal year end is January 31st, a time span greater than 3 months, so we must look to the rules regarding accounting methods when there is a reporting lag. ASC 323-1035-6 allows the investor to use the investee's most recently published financial statements to calculate profits and losses if the annual financial statements of the investee are not sufficiently timely to value the investment. Using this logic, we will use the DocuSign's quarterly financial statements to calculate our earnings.
Thank you for your time. We will now open the floor for any questions.